Welcome to the Tech Money Podcast, where the worlds of technology and personal finance collide. Hosted by certified financial planner, speaker, blogger, and self-proclaimed personal finance nerd, Malcolm Ethridge. Each episode aims to make you just a little bit smarter about your money, all from the perspective of the tech professional. Without further delay, here's your host.
Hey there, listeners. Malcolm here. And on today's show, we're talking equity compensation. More specifically, we're talking about some financial planning rules of thumb for people who hold stock options, whether they're in the form of incentive stock or non-qualified stock options. A couple of years ago, I wrote a blog post titled, "Your Employer Just Granted You Stock Options, Now What?" And in there, I pointed out that there's a wide gap in the amount of information and education that employers who offer equity comp actually provide to their employees who receive it. And as you likely heard me say on another episode in this same series that's all about equity comp, the big challenge we're looking to help folks overcome is that stock plan participants receive a decent amount of education from their employers, but almost zero guidance on what to do with those shares once they receive them. And so I decided I'd call up someone I know who knows way more than I do about this topic and just have a conversation. Bruce Brumberg is the co-founder and editor-in-chief of mystockoptions.com, the go-to resource of financial planners and other such professionals looking for advanced educational content on stock options, restricted stock, ESPPs, and performance shares, to name a few. Bruce holds degrees from both the University of Michigan and the University of Virginia School of Law. And in addition to his work at mystockoptions.com, he also runs a similar site called mynqdc.com, which is devoted to the world of non-qualified deferred comp. As if he didn't have enough to do, Bruce is also a regular contributor to Forbes and has devoted most of his professional career to making complex legal and tax concepts understandable for people who do not enjoy reading the Internal Revenue Code as he does. So with that brief introduction, welcome Bruce Brumberg to the Tech Money Podcast.
Welcome, Malcolm, and I appreciate the opportunity to talk to you about stock compensation.
Coming on, because as I alluded to, no one I know enjoys this stuff nearly as much as you do, which is really interesting. But I breezed through your resume pretty quickly there in my intro. What did I miss?
Well, as it relates to equity and stock compensation, you've probably hit the main things professionally. I did practice law for a few years, and then I had my own legal financial tax publishing companies for a number of years, back to 1986, and we started mystockoptions.com 21 years ago this past June. So in 2000, we started up. I also have done a number of video production projects, including very popular insider trading prevention videos known as Think Twice. And then personally, I do a lot of other things too. I coach a high school tennis team, for example, in the spring. And, I have a family with 2 kids in their 20s now.
Wow. So again, as if you didn't have enough to do. And so just to get us kicked off here, I know that one of your top rules for managing equity comp is to set goals, right? And I know that probably sounds a bit obvious to anybody listening, but what do you mean exactly when you say that?
Well, the idea is that I've seen through the years that there's a lot of different strategies with stock options or restricted stock units or ESPPs. But the people who seem to be the most happy, the most satisfied with what they have or what they had, set a financial goal. Like they want to use the money to buy a house for a down deposit, or they want to use it for buying a second house, a vacation home, or they want to use it for college tuition, or they want to use it for a big vacation or whatever. And they say, that's how much I need after tax from the proceeds. And when the stock price reaches that point, they go ahead and they exercise the options to sell the stock, or they sell the company's stock. And they don't look back about it. They don't have second doubts like, well, the company stock kept going up. So that's what I mean by setting goals. Deposit on the house, for the mortgage, vacation, son or daughter's wedding, whatever. Set that goal and say, that's what I'm going to do with the share proceeds. And don't rush it either. A mistake sometimes people make is they say, oh, right away, my shares are vested, I'm going to exercise and hold them. You wouldn't want to do that if you had non-qualified stock options. Maybe if you had incentive stock options, but you wouldn't want to do that with non-qualified.
Well, another one of those rules, kind of staying in the same place, as I'm a regular reader of the content that you guys put out. And another one of those rules that I find is super similar, but You say to develop an overall plan. Is that different, or is that in the same vein as, making sure that they set that goal, that life event goal?
If you look at non-qualified stock options, because the treatment is a little different for ISOs and the strategy can be different. Mm-hmm. Non-qualified stock options, as soon as you exercise them, you're pretty much the same as buying the company's stock, and you now have to pay taxes on the spread. So you want to wait to exercise them if you think the company's stock price is always going to keep going up and you're still employed at the company. And so by waiting to exercise, you don't want to wait forever. So let's say you have a 10-year term and you're staying at the company for a while. Then you may say, well, in the last 3 or 4 years, I'm going to start exercising the options and selling the stock, almost like you would do income averaging of an investment, sort of doing the same thing. You're exercising to get out of the company's stock over a length of time. What can make it more complex is when you now also have, restricted stock units, mm-hmm. where you now have those vesting dates, or you have employee stock purchase plan, where you're also purchasing stock. So you have company stock in different forms, including maybe even your retirement account.
And a lot of folks come into contact with doing this work if they've stayed with the company for a while, they've got a good little mix of all of the different types of ways you can accumulate those shares, as you were alluding to there. So it is really important to make sure that you sort of sort out what's what and how it's all going to work together as you're developing that plan. So that's a good note. So you mentioned really quickly, as in your response there, about you're 3-4 years out from when you expect to leave the company, and making sure that, you exercise accordingly, leading up to that exit. But along that same line, one of the other things that you say in your writing is to learn what happens when you leave your company and then tell your family members. The first part is a bit obvious, right? But then why tell family members?
Well, the reason you want to tell the family members is not because you think one of your spouse is going to leave you, and so they want to have some rights to it, or your kids are going to look to that income to inherit or have you buy something for them. It's in the event you are disabled or pass away. Mm-hmm. Because like with stock options, you have to exercise them, and there's a set term. And if you don't exercise them, you'll lose them. And so if you have, let's say, non-qualified stock options, and there's 4 years left on the term, then if they're inherited or you have a beneficiary designation, they need to know that there's 4 years left, but maybe there's only 6 months left or less. And by the time the estate's probated, who knows? They could be forfeited. Also, in many stock option plans or restricted stock unit plans, in the event of death, there's an acceleration of vesting, or you can actually go to the compensation committee and say, well, in this situation, this was a key employee, an executive, and the compensation committee may make a decision to accelerate the vesting or let the vesting continue for those grants that are not vested yet.
Yeah. You started to allude to your rule of thumb, if you will, or best practice around option holders, specifically waiting as long as possible to exercise, right? That's kind of just the general guidance that we would give almost anybody. But are there any exceptions to that rule?
Well, you need to know what kind of stock options you have. So if you have an incentive stock option, that's a big exception. Mm-hmm. Incentive stock options, if you exercise and hold the shares, and you do that holding more than 2 years from the grant date and more than 1 year from the exercise date, then when you sell the stock, the entire gain over the exercise price is going to be long-term capital gain. So let's say your exercise price is $10 a share, and then you've held it long enough, there's more than 2 years from grant, more than 1 year from exercise, and you sell it at $30 a share, then that difference between the $30 and the $10 a share, that $20 is going to be all long-term capital gains. Now, of course, that spread at exercise, that's part of the AMT calculation, which makes ISOs even more complicated. Yeah. But that is a big exception, if you have ISOs. If you have non-qualified stock options, which are the more popular kind, and they don't have any special tax treatment under the tax laws, and the company doesn't have to follow any special rules for granting them, which makes them more popular for a company to use, then whenever you exercise them, you've just fixed the tax treatment at that date. So you exercise the option, and what makes the stock option so valuable is that fixed exercise price. So I was using that $10 example. You get the grant at $10 a share, and that's the current market price. price. The company has to grant it at the current market price. And then you hold it for 8 years, and now the market price for that company stock is $80 a share. You have that fixed exercise price, the fixed purchase price. You're buying the $80 stock for $10 a share.
Mm-hmm.
So that full amount of exercise in the future is going to be ordinary income. But the total after-tax amount that's going to be in your profit and it's going to be in your pocket is going to be more than if you exercised it when the stock was $12 a share and then held the stock and then sold it at $80. On mystockoptions.com, we have a tool. It's called a comparison modeling tool that actually shows you that analysis. We have a patent for it because it's sort of counterintuitive. People think, oh, why don't I exercise non-quals early?
Yeah.
Pay taxes on the spread and then start the capital gains holding period and then sell it at that $80 a share I was giving you. But when you look at the numbers, you will pay more in taxes by waiting to exercise. Mm-hmm. So that the full spread between that $10 price and the $80 market price is ordinary income. But your net after taxes, the amount you actually walk away from, is going to be much larger when you wait to exercise, assuming the stock price keeps going up. You can't wait to exercise, let's say, if you leave a company, because there's going to be those post-termination exercise rules.
Sure.
And the company is going to say, okay, you had a 10-year term, no more.
Yeah.
That's cut short. Your term is now going to end in,
90 days or 60
90 days after you left, or sometimes immediately. Now, in cases of disability or retirement or death, there may be a longer post-exercise deadline period, but you have to be very much aware of that. So that's another exception. Obviously, you can't wait forever because you're going to forfeit valuable stock options. The concept called leverage with stock options, and that's it's sort of like the same as with a mortgage is often used as an analogy. Like when you buy a house, you're putting down a certain percentage. You're not
mm-hmm.
paying the full amount in cash. Let's say maybe you want to pay the full amount in cash when you have it. But usually, let's say you put down 10% or 20%. You can think of the same thing with stock options. You're just putting down a sort of a percentage amount, but you don't have to come up with it. And that's that exercise price. So we had that $10 exercise price for the $80 stock. You can think of that $10 price as how much you put down on the mortgage. And it makes sense to sort of let it ride as long as possible. At a certain point, though, the spread is so big, I'm using 80 and 10.
Sure.
A random number. That's a further stock price increase doesn't really make the spread be that much larger in terms of the percentage amount.
So wait a second. So you're saying if I'm at 80 and it goes from 80 to 85, right? Versus me going from 10 to 100 or 105, there becomes a less sloping, a less slope to that trend line, right? The further out I go, you're saying going from 85 to 100 or 80 to 100 isn't as important as going from 10 to 80. Is that correct?
The difference between 80 and 85, that is a bigger percentage increase than going from 100 to 105.
Got it. Got it.
Or you think of the spread difference, the difference between 100 and, $10, the difference between 110 is 90.
Mm-hmm.
And so the difference between the 80 and the 10 is 70. And so you do the math. I mean, a real simple example is, let's just say the stock price is, $10 a share,
mm-hmm.
and the exercise price is $9 a share. So you have just a $1 spread there. But now the stock price goes up, just another 10%, right? So now the stock price is $11 a share. But now your spread is $2. And so you went from $1 spread when the market price was $10 to now $2 spread when the market price is $11. But that's actually a 100% increase.
Yeah.
In the proceeds. But as the spread gets bigger and bigger, the math doesn't work out the same way. So you say, well, maybe it's not worth the risk, to let the option keep riding. You may want to. I mean, sometimes the best wealth is created by those who wait the longest.
Sure.
But at the same time, options can be very fragile. We're just focusing on stock options. It's a whole different strategy with restricted stock or restricted stock units in a public company where pretty much it's the same thing. The taxes are fixed when the vesting date occurs, and do you continue to hold those shares or not?
So one other thing I want to get into before I sort of turn the tide a little bit is that you and your team say to average out of your options exercises, right? Not necessarily have them all happen in the same year. And I assume this is only advice that's pertaining to a cashless exercise type of scenario. But can you explain what that means and why that would be important?
I mean, the idea being to wait to exercise. I mean, there's different factors. The way I really think about
Well, no, I mean the idea of just averaging out those exercises versus having it all happen at one time.
Well, again, there's various factors that go into a decision to exercise. I like to say they're personal factors and then they're company factors. And, one of the personal factors is what tax bracket you're in, for example. Mm-hmm. And so you want to know what the bracket you're in, and you want to know how much room you have in that current bracket before you're going to move up to the next one. Again, we're not talking about ISOs with the AMT calculations. That's very different. We're just talking about a non-qualified stock option exercise. So when you do that exercise, that spread, the difference between, again, we're using the 10 and the 80, that's $70 per share. That's going to be part of your ordinary income. So you have to decide, if I do that now, then I'm going to get that additional income hit, and is it worth it? Mm-hmm. It's going to bump me into the next tax bracket. So this, especially at year end, it's something people are going to think about. If some of the tax brackets are going to go up the next year, it's something a lot of people think about too, about how to play with the different tax brackets. But they often say, you shouldn't let the tax tail wag the dog. I don't know who came up with that idea. I don't know why it's a dog. It could be dog, but that's what it is.
Yeah.
And it's something you just have to, think about, but when options are close to expiration, I think that's when it's more of a factor too. Let's say you have this 10-year option, you've been waiting to exercise, and you now in year 8 or 9, and then you know that your tax bracket next year is going to be higher, or taxes are going to go up next year for the bracket you're in. So then you maybe decide, might as well exercise now instead of waiting.
Yeah, I always like the idea of averaging out of the positions. And, for certain folks, depending on their role within the company and their proximity to privileged info, right, they'll have to create a 10b5-1 plan, whether they want to or not, in order to sell those shares, which essentially forces them to average out systematically anyway. But for the rest of those plan participants who do have those options, creating a sort of 10b5-1 of their own is a good way, in my opinion, to go in order to help take the emotion out of determining when to exercise. Because it always, as you kind of got to, the longer you hang on to them, the higher the emotions get when the conversation about exercising comes to the forefront.
Yeah, well, when you talk about the WorldTempe 5-1 trading plan, then what you're looking at is someone setting up a plan of exercising and selling, their company stock, or just selling their company stock they own with a set schedule. You have to set up that plan when you do not know material non-public information. And there's also certain best practices that have evolved, like, you want to have a certain cooling off period before the first trade. And maybe you don't want to make any trades outside the plan. You may not be able to modify the plan. In the near future, there will definitely be SEC rules on that. Mm-hmm. The current SEC chairman has made it very clear that he thinks there's been abuses in these plans. So you want to be following that development. When people are listening to this podcast in the future, and hopefully, it will be something people want to listen to in the future, they'll look back at it and they'll say, oh yeah, those changes happened. So I don't know if when the SEC adopts these rules, they're going to propose them first, and they'll definitely be coming out this year, is my prediction, in 2021. Yeah. There's always going to be a time period where people give comments and then they'll be modified. But even what the SEC proposes could start being the best practices. And it may make these plans either less popular or could make them much more popular, because now you're giving them even more publicity. And also you've sort of codified, you've set up a set structure for how to do it with the SEC's blessings. I've never seen, either securities rules or tax rule changes that don't have unintended consequences. So we'll have to see what happens.
So let's talk taxes for a moment, right? You say, you've been saying for a while, plan participants should determine their tax rates in advance and, kind of watch out for those bracket triggers. But can you say a little bit more about that, specifically the tax bracketing approach to this?
Yeah, I mean, that's one of the factors. So again, we're looking at employee stock options, let's say non-qualified stock options, where when you exercise that spread as part of your ordinary income. So if you want to sort of time it so you don't have yourself pushed into the next tax bracket, you just want to be aware of that. There's no fancy calculation about it. You can just look at last year's tax return. And if you think your income is pretty similar to this year, you just add the amount of income you expect to get from the option exercise to your taxable income. Again, it's the taxable income. There's various deductions that occur, not just just don't take your salary and multiply it by, monthly salary multiplied by 12. You have to really look at your tax return and see if that additional income is going to knock you to the next tax bracket. Now you can say in some ways it's penalizing that income, but you're really looking at the marginal income and what it does to your marginal tax rate. As a financial advisor, you may just say that you really need to look at your effective tax rate. And, in other words, why are you sort of penalizing in some ways the non-qualified stock option income? Because you're looking at it on top of it. Well, I know people who decide, for example, with Social Security, there's a yearly maximum for Social Security, so Social Security wage based. And I've heard people who decide that they want to exercise their stock options early in the year, let's say, to push themselves above the yearly wage base, and then nothing comes out of their salaries. It's like giving themselves, a 6.2% raise, because the Medicare is uncapped, but Social Security is capped based on the wage base. Then I know people who do the opposite. They wait to exercise the stock options until they're above the wage base for Social Security on their salary. So there's different things you can play around with. But again, as I was mentioning before, you don't want taxes themselves to be really driving your decision unless it's closer to expiration. I think when you're getting close to expiration, maybe it's more of a factor. There are other things you want to look at. Diversification. Percentage of your net worth in company stock, and I would recommend at least you consider the vested stock options as part of that concentration calculation.
Sure.
And that's important. Also, what we talked about, having goals for the stock options. I mean, that's really important too. I mean, let's just say there's a big run up in your company stock price and your term of your option is, only halfway through. You're in year 4 or 5. You may decide, hey, now's the time to exercise and sell the stock because there's been a big run up and I don't know what's going to happen. My company's drug has been approved and it's selling like crazy, but there's not as much in the pipeline. And that's not insider trading. You just happen to know that information. Probably the analysts know it too. And you may decide, now's the time to exercise and sell the stock. I don't think it's going to go much higher because there isn't that risk. And we already have that big spread there.
I know, again, because I constantly read what you guys put out on this topic. One of your recommendations is that all option holders learn about the alternative minimum tax, right? You're talking about Social Security wage base and people who are in position to have the ability to decide to intentionally exercise enough to get above that $138,000 or whatever the number actually is at this point, right? Yeah. So we're talking about people who have a pretty significant annual income, but AMT is not an easy thing to learn for most financial planners, right? Let me say that, or even some tax professionals for that matter who maybe won't admit it. But any recommendations for how to go about learning that?
Well, I think the most important thing to know is what the rule is that would trigger AMT. And that is when you exercise incentive stock options. Now, we've been talking a lot about non-qualified stock options. Now we're talking about incentive stock options. It's a confusing term because really they're all incentives, right? But an incentive stock option or ISO is an option that gets special tax treatment under the tax code. And there's different rules a company needs to follow. But the big thing is that, and I mentioned this a little earlier, that if you hold the shares long enough, meaning 2 years from grant date and 1 year from exercise, and then you sell it, then the entire spread, that difference between the $10 I was using and the $80 and $70 is all long-term capital gains. And right now that's taxed at a lower rate, 0 or 15 or 20% plus the Medicare surcharge of 3.8%. However, when you exercise those ISOs, and you hold it through the calendar year of exercise. So that $10 exercise price, the market price, let's say when you exercised it, was $15.
Sure.
That $5 amount per share, that becomes part of your alternative minimum tax calculation. And it becomes part of your alternative minimum income. So that's the first step.
So whatever happened in that first year after I was granted the shares.
First calendar, it's very important to know that you could exercise it in November.
Yep.
And hold it for 2 months. And it's now January, but that spread at exercise is part of your AMT income calculation. So the first thing is, what is the income, AMT income? Then what you're doing with the AMT income is you're pretty much adding back certain things to your income. There isn't the same standard deduction or itemized deductions on the AMT. They're different. And one of the reasons people are less likely to trigger AMT is the property tax limit. It can only be $10,000 a year.
Yep.
State or local taxes. And that used to be an item you would add back to AMT income. And so that in and of itself, putting aside the ISO spread at exercise, just your property tax based on where you live could trigger the AMT. So now you come up with the AMT income amount and you deduct from that an exemption amount. So you don't have that standard deduction like you do under the ordinary system. You have an exemption amount. And under the Tax Cuts and Jobs Act, that exemption amount went up a little bit.
Sure.
But like a lot of tax code provisions, there's a phase out of that exemption amount. And the big change under the Tax Cuts and Jobs Act is where the phase out starts. And it's 25 cents for each dollar over the initial threshold. Went way up. So you're going to be able to use most likely that full exemption amount. I think, off the top of my head, I could go look at the number now if you want me to say it. But it's over $1 million worth of AMT income before the phase out starts for someone filing jointly.
Mm-hmm.
So fewer people are paying AMT now for multiple reasons. One of them is that it's much less likely that the AMT income exemption amount is going to phase out. And then also because the state and local taxes are limited to that $10,000 amount. So now you come up with your AMT income amount and you multiply that by 28 or 26%.
Sure.
The reason those percentages are the AMT tax rate, and it's just there's like 2 brackets. That's it. It's pretty much a flat tax, which, by the way, is a much simpler tax in some ways. When they talk about tax reform and increasing taxes, sometimes I think that just a flat tax will be much simpler.
There's not much about the code that people ever refer to as simple. So
right. The simplest way for political reasons, the flat tax is never really it's taken off. And in other countries, it does. You just have a flat tax, and you have people below a certain income aren't taxed, and then people above that have a flat tax, and there's just very few deductions. But whatever. I mean,
that's a whole different podcast.
When you look at the newest proposals, increasing the top rate and doing this with capital gains and all that, it's like, well, if you decide you want to raise X amount of money, how about just try a flat tax and try to push that forward?
Yeah,
because it actually could have more bipartisan support than making the code more complicated. But in any case, if you have ISOs, the key thing is if you have incentive stock options, ISOs, you exercise and hold the shares through the calendar year of exercise. That spread at exercise is part of your AMT income calculation. It's much less likely you would trigger the AMT, but you still need to go through this whole calculation to see which is higher, your AMT tax or your ordinary tax, the 1040 tax.
So let's stick with ISOs for a second, but shift the conversation to those who are working for privately held companies, right? So I occasionally will work with someone who works for a privately held company, then they walk into work one day and all of a sudden an announcement is made that there are plans to go public, right? And I've read your advice here, and much of it centers around familiarizing yourself with the plan's vesting requirements, right? That's really where the meat of the articles land. So can you say a bit about that?
Are we talking about focusing on stock options or restricted stock units?
No, this is for the stock options. The RSUs are a little bit more self-explanatory in a lot of cases, but the ISOs still, in this case, company decides we're going to go public. Everybody's award agreement says something different. I've found in a lot of cases, even dealing with like 3 people who work for the same company and have similar tenure, those award agreements don't always say the same thing. That's more what I'm thinking about. Those vesting requirements are interesting.
Well, there's 2 kinds of stock options, 2 kinds of structures. Mm-hmm. The tax treatment for stock options in a public company and a private company are the same. And it seems like they shouldn't be the same. Because there's no liquidity. When in a public company, people often exercise and sell the stock or some of the stock to cover the exercise costs or the taxes. But you can't do that in a private company.
Sure.
Do you think the tax treatment would be different? And it's not. There's a tax code provision that was in the Tax Cuts and Jobs Act called 83I that provides companies the ability to grant a special kind of option that would allow you to defer the income for up to 5 years. But very few companies are doing that because that provision has some flaws in it. I'd like to see it amended. I've made some proposals to make some changes in it, which can make it very attractive. But let's just look at the current tax code and the current structure. Mm-hmm. So because of this tax stream being the same for private companies as it is for public companies, a lot of smart lawyers and tax experts came up with a couple of different designs for private company pre-IPO stock options. One of them is called an early exercise stock option. Mm-hmm. Sometimes it's called an immediately exercise stock option, or it's called an 83B stock option, or restricted stock option, or whatever. And that's when you get the grant right away, even though there is a vesting provisions, it allows you to exercise them immediately. And so now you get the stock. However, it has a vesting schedule similar to what the stock options had. So you get these stock options, you get 10,000 stock options at 18 cents a share, and you can exercise them all immediately, to 18 cents times the 10,000. I try to do the math during this podcast, and even though it seems simple, I probably would get it wrong. So you come up with that money, not much, right? And so now you have, those 10,000 shares. Now they have to vest. So if the company has, half of it vests after 1 year and then monthly after that, it's going to be the same vesting that's going to apply to your stock.
Sure.
And so only once it vests, you truly own the shares. And even if you think you truly own the shares, if it's a private company and you leave it early, then you're probably going to have to sell it back to the company. So the vesting is important there to realize that when you exercise the options in an early exercise stock options, and if you want to do it, you should do it right away when there's no spread and there's not going to be any ordinary income or AMT if you do it right away. And you're confident the company is going to make it go public or get acquired.
I want to add in there real quick while you're talking about the 83B, that one of the things that I see get lost in people's understanding of the rule and desire to take this election is that you're making a bet that the value of those shares is going to continue to increase significantly. And these are privately held companies, and we know how volatile startups can be. And so I just want to make sure that people listening to this are aware that that is essentially the bet that you're making. I know a lot of times with any kind of options, right, we're assuming that the stock price is going to go up, but especially with an 83B election where you're raising your hand to the IRS and saying, I want to pay the taxes now, I want to pay the taxes early. You are definitively betting that stock price is going up from where it is. And again, in startup land, who knows, right? And so I always caution people, not against doing it, but just I want to make sure that people are aware of that's what you're saying when you make that election.
Well, it's a question of whether there's any spread or not. I mean, some people say, that you would want to do it, you either want to do the election and the exercise early, so there's very little spread or no spread at all. So if you get this grant at 18 cents a share, that's the valuation. There's been a 409A valuation. That's the current valuation of the grant. So you're not going to owe any taxes. So the reason you do the early exercise is you start the capital gains holding period early. And then also there's no or little ordinary income recognized. You have the risk. You have the risk that you're going to lose that. You have the risk that you could be holding it for 10 years and maybe you could have done something else with that money, bought Amazon stock at the same time you bought this.
Yeah.
You want to be a shareholder of the company and you do that. So in terms of investing, the 83B is something you would do, and you have to do it within 30 days of exercise. You have to make a filing with the IRS. There's no official IRS form, but there's been IRS guidance on what should be in that filing. And then you want to give it to your company. You no longer have to attach the 83B election to your tax return. You still have to do that. The tax treatment for non-qualified stock options is pretty straightforward. For ISOs, based on guidance that came out from the IRS in 2004, if you do a disqualifying disposition before the shares have actually vested, then the tax treatment can get a little more complicated for you. So the other strategy is, wait till later on. So the company is going public or about to get acquired, and then you do an election. And then if it's one of those 83B ones, you would have a situation where you have taxable income, but you do start your capital gains holding period early. So the other strategy would be you wait, particularly if they're ISOs, you wait till late. Wait till, your company has filed its S1, or it's about to file an S1 to go public, or, it's pretty seriously looking at it. And so now you make an ISO exercise. And if you hold it at least 1 year from exercise, because the 2 years from grant requirement is long past.
Sure.
Now I hold it for 1 year from exercise. Then that entire difference between the sales price and the exercise price is going to be capital gains income. And what's happened in the past year, you've had this big upturn in IPOs. So more employees have been hit with ISO AMT issues than in the past, because they did decide to exercise before the IPO and then hold the stock long enough, but they had the 18 cent share exercise price, and the stock goes public at $15 a share, or it's $15 a share from the most recent valuation. And so you have some issues there with more AMT income becomes part of that AMT income calculation, and it's more likely that you may trigger the AMT. So you want to do that type of analysis. Now, let's say it's just a traditional stock option, the kind you get in a public company. Like a public company, there's no 83B election on stock options, because public companies wouldn't grant you early exercise options, because you might as well just buy it on the stock on the open market, right? Because the real thing in early exercise options is to exercise them right away. You might as well just let it ride for the public company. But if you have a regular stock option in a private company, then the tax treatment is the same, again, as in a public company. It's only when the shares vest do you need to actually exercise them. And then you have to figure out, well, I can't sell the stock. There's different financing techniques that have come up with. There's third parties, different companies that'll provide some financing if you want for the stock options. You can do that with the 83B one too. It's just that we're looking at a situation where, again, 18 cents a share exercise price, and now the options are vested, but you don't know if the company is going to go public or get acquired, and you don't know when that's going to happen. So now you go ahead and you exercise the non-qualified stock options, and the market price from the last evaluation is $5 a share, and you have the 18 cent exercise price. So that difference between the $5 and the 18 cents, that is $4.82, right? Yeah.
Yeah.
$4.82, right? That's part of your ordinary income. You're going to owe taxes on that, but you can't sell the stock for it. So it becomes more complicated.
Complicated is an understatement.
Yeah, more. Well, actually, it's not that good. The tax is straightforward. It's just you have to come up with the financing, and now you're out the exercise price and the taxes, and so the risk multiplies.
Yeah,
the risk you're facing.
Well, as we get ready to close out here, my last question is more of an opinion question than anything. So I want to preface it by saying it that way. It's not necessarily one that there's a hard and fast rule for, but because you're so versed in all of the different ways that a person could be compensated with equity, I think you're uniquely qualified to answer this one for me. Which would you say is the better way to receive that equity comp between ISOs, NSOs, RSUs, and even PSUs hanging out there? Meaning, if you were starting for a company today, right, and the compensation committee said, Bruce, it's completely up to you. You tell us how you'd like to receive your equity. What do you choose?
Well, some companies do have those kind of employee choice programs. I mean, it's not that common because they're more complicated to administer, where you can, choose options, restricted stock units, or sometimes just cash in terms of a long-term incentive. Because all this is considered an LTIP or long-term incentive plan. And it varies in a public versus a private company, and what your opportunity is, where you think the stock price is going to go. That's probably one of the biggest determinants.
Sure.
And also, how big is the grant? So with stock options, you're going to get a much larger grant than you will with restricted stock or restricted stock units, because restricted stock has a set value when it vests, where stock options are only worth something based on the appreciation, the increase in the stock price from the grantee. So let's say you would have gotten 30,000 stock options, you would only get 10,000 RSUs. So right away you're getting more of those stock options. And when you run the numbers and you look at it, you can see that it doesn't take that much of an increase over the term for the options to be worth more than the restricted stock or RSUs. I'm using restricted stock and RSUs for the same thing, which is basically, consider a full value stock grant. You just have to work at the company a certain length of time and you get the shares. They're pretty close siblings, RSUs and restricted stock.
But it sounds like you're leaning more toward the options versus restricted stock then.
Well, if you're confident that the company's stock price is going to go up.
Sure.
I happen to know some people different. We're in the Boston area, and I know some people who work at various pharmaceutical companies, biotech companies, some very high profile ones, and some of them, they got stock options before and the stock price has gone way up. And now they're hoping to get restricted stock units because they don't know what's going to happen with their company stock because it's done so well recently. So that's really what it really depends on. How many you're getting, what your tolerance is for the risk, and where the company stock price is going. In a private company, based on the tax rules, it's going to be stock options. That's just the way it goes. And an ISO would be a better thing to get if you don't think you're going to trigger the AMT and you're going to exercise and hold the stock. It's also with ISOs, don't forget, there's no withholding, there's no Medicare and Social Security that comes out at all. With non-qualified stock options, there is. The only thing with ISOs too is there's a limit on how many you could get in terms of no more than $100,000 worth vested or exercisables in any one given year.
Sure.
But if you have stock, if you're like set on exercising them in a private company and you're going to exercise them right away, then a general rule is you actually want to get non-qualified stock options. And the reason for that is if you exercise them right away, so there's no spread, forget no Medicare, Social Security, ordinary income. Then if the company should get quickly acquired, then you're in a better situation because you don't have to deal with this 2-year, 1-year kind of thing.
Gotcha.
But if you have, and so that it can be a better arrangement. You don't have to deal with the 2-year, 1 year. But with ISOs, you do have to deal with that. So if you're confident in your companies and you have the money to put up, then and then you're getting a lot more shares, then the stock options are always going to be better. Those are the big wealth builders.
I thought that's what you would say, but I you're the guy, right? The guy behind mystocoptions.com. And so I just, I thought since I had you, I would ask that question, but I appreciate it, Bruce. This has been great. Thank you for being so generous with your time. And I'm sure that my fellow nerds are going to appreciate all of the detail that you give with your answers and also the writing that you do. Where can people find you if they want to learn more about you and or mystocoptions.com after this goes live?
Well, thank you very much. Adding to what you said before, again, it's your risk tolerance really matters. If you're in a public company, the RSUs are going to have set value, and that's why some companies move to them too. They thought that their employees didn't have the stomach for volatility. But yeah, we have mystocoptions.com. Go visit our website, and we cover all types of equity compensation. I think in some ways, stock options have become a generic term for it. So we have ESPP content, tools, and stock options, restricted stock, and videos, podcasts. There's quizzes too. You can try some of our quizzes and courses we have. And we've been doing webinars. I know that you've watched some of those webinars. Thank you for that. So yeah, come out and visit the website. And we've been at it, as I said, this is over 20 years. We've seen a lot of different cycles and a lot of different changes in equity compensation, but we've become a very respected independent source with our content and tools on all types of equity comp.
20 years strong, and there is tons of content up there. I can't even begin to do it justice. But Eric with an A, why don't you go ahead and close us out, sir?
Absolutely, be my pleasure. Bruce, thank you so much for being on the show, of course. And Malcolm, thank you for creating this show to educate your audience. It's always a pleasure being with you. And of course, our last thank you goes to you, the listening audience. Thank you so much for tuning in and listening to the Tech Money Podcast with Malcolm Ethridge. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Malcolm comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your colleagues. Again, thanks for listening today. For everyone at Tech Money, our hope is that this show helped make you a little smarter about your money.
This has been the Tech Money Podcast. For more information on today's topic, to review the show notes, or to catch up on past episodes, be sure to check out malcolmethridge.com/podcast. And if you have an idea for a show topic that you'd like us to cover, or you want to send us feedback, the web address again is malcolmethridge.com. You can also find Malcolm across all social media platforms at Malcolm on Money. This episode was written and created by Malcolm Ethridge, with the production, the editing and sound controls powered by Proudmouth. This has been a Malcolm on Money original. Thank you for listening. The information shared in this recording and by its guests represents the views and opinions of the guests and does not represent the views or opinions of the host. This content has been made available for informational and educational purposes only. This content is not, nor is it intended to be a substitute for professional financial advice. It is always recommended that you seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your personal financial situation.